Today I'm going to answer the question, what is agreed value in a property policy and why you should have it, coming right up. Let's get right into it. Agreed value is an optional endorsement to a commercial property policy that waives coinsurance and essentially provides that the amount of insurance in the policy on a building and/or the business personal property or contents represents an agreement between the insured and the insurance company underwriter as to what that property is worth. A statement of values, which we'll talk more about in just a minute, is usually required to be submitted annually by the insured to the insurance company to substantiate and agree upon the values. All right, let's break that down into English. Whether you're insuring a manufacturing facility, a distribution warehouse, an office building, an apartment building, or any other occupancy on a commercial package policy, meaning that it's not on a BOP policy, you're faced with issues regarding valuation of property. The same is true for business personal property or contents inside of that building. Commonly, on a policy, you'll see the amount of insurance for the building and contents, and then you'll see a valuation clause or option that can insure the property for its replacement cost, noted as RC on the policy, or its actual cash value, which is often noted as ACV on the policy. Replacement cost means the amount of insurance on the building or contents represents the full value to replace it at today's costs. In other words, it's not going to be depreciated. If the property is insured on an ACV basis, then the value represents its depreciated value. Obviously, you want to get replacement cost or new for old valuation over ACV in most circumstances. The next item on the policy is usually going to be coinsurance, which is expressed either as 80% or 90%. Coinsurance is the insurance company's way of making sure that you insure a property's value to at least that percentage of its value, and if you don't, you'll co-insure or share proportionally in any partial claim that happens. It's sort of a penalty for underinsuring property. Now, here's the important part. Coinsurance, and in fact, property values can get very messy when there's a claim, even if there's no intent to underinsure it or to skimp on the values. So to avoid having coinsurance on a policy, you should opt for agreed value, which I mentioned earlier is a value that you and your insurance company agree upon as the accurate replacement cost of that property. If there's a claim down the road, there's no potential penalty if the property was underinsured, and it completely removes that discussion from the claim settlement, which is good. How do you establish agreed value? This is where a statement of values comes in that I mentioned earlier. A statement of values, or SOV, can be made on an accord form or on the insurance company's specific SOV form, and it represents your values that are agreed upon. Now, if you try to sneak in a building's value that is significantly less than its real value, a good underwriter is going to catch it and question it, and they may not agree on that value amount, so getting values accurate is important. What's also important is getting your SOVs into the underwriter by the renewal date of your policy, because if you don't and there's a claim, you're now going to be subject to coinsurance, which is something you wanted to avoid in the first place. So there you go. That's the breakdown of what agreed value is on a property policy. If I didn't answer your question entirely, or if it spawned additional questions, feel free to reach out to me. My contact info is coming up and it's in the description box below. Finally, you may want to check out this video I did, it's either here or here, on commercial property valuations and inflation. And before you go, do me a favor and hit that thumbs up button. Thanks.